Today we learned that inflation is down to just 3%, and I'm going to give you 4 things that you should know about inflation, what it means for the stock market and the economy. I'm also, in the middle of the video, going to give you a few thoughts about student loans and how this can impact inflation moving forward. All right, let's go ahead and begin. The first thing is that we are very, very close to the Federal Reserve's target. They have always tried to get inflation at 2%. This has been their thing for decades, and they have done it for the most part, with the exception of the last 2 years or so. Last year we're at 4%, this year we're at 3%. We might actually get to 2% by the end of the year. This is the lowest point we have seen since March of 2021. We on the right path. Okay, we are almost there, and I'm excited to get everything back to normal in terms of prices, because rent and everything else is too damn high. All right, number 2 here is job growth is still good. This had been a concern because when you increase interest rates and you slow down the economy, businesses stop hiring, you run the risk of running into a recession. And almost every time the Fed has raised rates this quickly, like you did in the 70s and 80s, you push yourself into a recession. That's not great, but we have not done that. We have added jobs to the U.S. economy in 30 consecutive months. That is more than 2 years, y'all. More than 2 years, we've consistently added jobs to the economy. And when we look at other countries, whether it's places in Europe, whether it's Canada, whether it's Mexico, places in Asia, we've actually done a lot better in fighting inflation than anybody else. And that is rare to say, but that is incredibly astounding and good to say as well, because we weren't the only country that was dealing with really high inflation, and we've been able to knock it down and still sustain the economy without going into recession, at least at this point in time, which is amazing to say. I think we're all on board. And observation number 3, the stock market was up too, which is great as well, because sometimes we get great inflation numbers, but the stock market is a little skittish and falls because they think we're going to fall into a recession. But finally, it looks like the stock market is agreeing here that we are just 1% away. The economy is still strong by most measures, and we might be able to get out of 2023 and maybe even get into 2024 without the threat of recession hanging over everyone's head, which I think we would all enjoy. Now, observation 4 here is about a potential recession and where we are. It doesn't seem like we're going to get one, which is something I've said a month or 2 ago. Okay, you definitely want to go back and check that video out, because again, unemployment is low, we're adding jobs, and inflation is consistently falling. The question is this: is the Fed going to raise rates 2 more times this year? This is something that they said. Okay, they paused it last year or last month, say, hey, we're going to wait, see how things play out. We did see some bank failures, but we're going to do at least 2 more times. Okay, so that's one concern. Could these 2 cuts be the 2 things that push us into a recession? Possible. Not sure how likely that is, but the bigger thing, if you ask me, is student loans. Now remember, 40 million people who had federal student loans have not had to pay since 2020. Okay, that is 3 years of not making those payments. And now, because of the student loan plan that was blocked by the Supreme Court, we can talk about that in a separate video. But now, because of that, those student loan payments are going to start on October 1st of 2023. In addition to that, the average student loan payment is about $500, which means that is $20 billion taken out of the economy every single month. Not just 1 month and a one-time thing. That's really for the foreseeable future, because some student loan balances are going to take 10 years to pay off. So now think about this as you are looking at paying for things, whether it's getting a new apartment, getting a new car, so on and so forth. If you now have to pay an additional $500 that you weren't used to paying for the last 3 years, that's going to shift a lot of your consumer behavior, which is going to translate to some companies, and is going to translate to the stock market, and obviously going to translate to the overall economy. The question is, how big of an impact is it going to have? If I now have to pay or go back to paying $500 a month, does that mean I'm now going to shop less in the holiday season? Does that mean that companies like Amazon, which we had talked about earlier this year, companies like Target, companies like Walmart, are they now going to start to see less earnings? Are they going to sell less things? And how is that going to play into the labor market, right? And when you think about that, think about people spending less and then paying more for debt, especially when it comes to the consumer side and when it comes to the business side, if the Fed decides to raise rates 2 more times. That is the biggest scenario. Now, if the Fed raises rates twice and student loans come back online, which we know they will, then yeah, we will hit that 2%. Okay, that I don't have any more doubts about. We're going to hit the 2%. The question is, at what cost, right? Will one rate hike do it by itself, or could we just leave everything alone and it's just gonna fall on its own? Or could we just start paying those loans back and just it fall on its own, right? And go back to 2% without the rate hikes. That would be my best case scenario. But that is something that we're going to have to see. And I'm curious on whether or not the Fed is going to even consider how that $20 billion a month is going to impact the economy. What we do know is that that $20 billion a month has helped a lot of businesses. It's one reason why companies were able to raise their prices and people still pay. Is one of the major reasons why people were even buying homes to begin with, myself included. So it does have a major impact on the overall economy. You can also argue that it is one of the major drivers of inflation. And to a degree, I would say 30% of that is true. We do have data to support that. So that is the big thing to keep your eye on. And it's probably going to be the biggest thing on how the narrative is going to be for 2024. And I'm telling you right now, in July, that is going to be the narrative. Will student loans plus 2 more rate hikes force, the question of recession in 2024? Because people are going to push back the recession conversation because it's almost obvious it's not going to happen this year. But that is the biggest thing. When you start to see that this impacts retail spending, which I assume it will, we're going to take that. We're going to start reporting earnings in 2024 in January and February, and then we're going to start to spin narratives around that based on how those numbers are, which I would expect to be a bit lower. So those are my expectations. Those are my expectations, but obviously there's a lot of time between now and then, so I'm very curious to see what is going to happen. But that's what you need to know. The last thing that you need to know as well is I did an entire video on student loans, the impact of them, and how it can impact the economy in relation to inflation. You want to make sure that you check that video out here. All right, that's it for me. Talk to you later. Bye.